Okay, so you want to own a ship. Not a yacht, not a fishing boat. A real commercial vessel. Picture it. Your ship leaves port carrying thousands of tons of cargo. Every day it is at sea, it can generate tens of thousands of dollars in revenue. On paper, this looks like the ultimate cash machine. A modern container ship can cost $100 million or more. A large crude oil tanker can cost around $60 million. And the biggest vessels can push well beyond $200 million. So you might think the game is simple. Buy the ship, fill it with cargo, collect the freight. Except that's not really the business. The ship is only the visible part of the machine. Underneath it is a brutal financial system where fuel, crews, insurance, port fees, maintenance, financing, and regulation are constantly eating the revenue. And here's the part most first-time owners miss. A ship can earn millions of dollars in a year and still lose millions. Why? Because the owner isn't selling the ship, they're selling time. Every day the vessel sits idle, breaks down, waits for a berth, or travels without profitable cargo. The owner is burning money. A $100 million asset doesn't care whether you are rich or broke. Its bills keep arriving. So, before we talk about owning a ship, we need to understand what you're actually buying. Because you're not buying a boat. You're buying one of the world's most expensive machines that has to keep moving to make money. Now, here's where the mental model gets more complicated. There isn't one type of ship business. There are several completely different businesses hiding under the same word, shipping. Tier 1 is the small commercial vessel. Think tugboats, workboats, small cargo ships, and coastal vessels. Purchase prices can range from roughly $1 million to $10 million, depending on age, size, and specializations. These ships serve ports, construction projects, offshore operations, and short regional routes. Tier 2 is the workhorse, the bulk carrier or medium-sized tanker. These vessels can cost roughly $20 million to $60 million new. A bulk carrier might transport coal, grain, or iron ore. A tanker moves crude oil or refined petroleum. The economics are heavily dependent on daily charter rates and fuel efficiency. Tier 3 is the large container ship. New vessels can easily cost $100 million, with larger modern ships reaching $200 million or more. Their entire business revolves around moving standardized containers between major global ports. Then comes Tier 4, specialized and luxury vessels. Think LNG carriers, cruise ships, vehicle carriers, or massive offshore vessels. These can cost anywhere from $100 million to well over $1 billion. And that price difference isn't just about size. It changes everything. A small vessel might operate with a compact crew and regional contracts. A mega ship requires sophisticated navigation systems, international compliance, specialized crews, massive insurance policies, and access to global ports. So the question isn't simply, how much does a ship cost? It's, what economic job is that ship built to perform? Now comes the expensive part, actually getting the ship into the water. Let's say you want a modern $50 million commercial vessel. That $50 million is only the beginning. First, you need financing. If you borrow 60% of the purchase price, that's $30 million of debt. At an 8% interest rate, you're looking at roughly $4 million in annual interest before you've moved a single container. Then there's the crew. A commercial vessel might require 15 to 25 people on board, depending on its type and operating requirements. Salaries, food, travel, training, and certifications can easily push annual crew costs into 7 figures. Then comes fuel. For a large ship, fuel can cost tens of thousands of dollars per day when operating. At $30,000 a day, just 250 sailing days means $7.5 million in annual fuel expense. And the hidden costs keep coming. Insurance can run hundreds of thousands or even millions of dollars annually. Port charges, canal fees, classification surveys, communications, maintenance, spare parts, and environmental compliance all take their cut. Then there's dry docking. Every few years, the vessel has to leave commercial service for inspection, repairs, painting, and mandatory maintenance. That can cost hundreds of thousands or several $1 million, while the ship generates zero revenue. Read that again. Zero revenue. The most dangerous expense, however, is depreciation. Your ship is a depreciating machine exposed to wildly changing secondhand values. So you're carrying debt, paying operating expenses, and watching the asset itself potentially lose value. That's why owning a ship isn't just capital intensive. It's cash flow intensive. Now, here's where the money reveals itself. Most people assume ship owners make money by charging for cargo. That's incomplete. The real profit engine is the spread between the ship's daily revenue and its daily operating cost, multiplied by utilization. Think of the vessel like a hotel room that costs $20,000 a day to operate. If you can sell that day for $30,000, you make $10,000. If the room stays empty, you still lose $20,000. Same ship, same cost. Completely different economics. Suppose a vessel earns $35,000 per operating day. Fuel, crew, insurance, maintenance, and administration might consume $22,000. That leaves $13,000 before financing and taxes. Now multiply that by 300 revenue-generating days. $13,000 times 300 equals 3.9 millions. That sounds fantastic. But here's the catch. The remaining 65 days aren't necessarily free money. If the vessel spends 30 days repositioning, waiting, undergoing repairs, or sitting idle, revenue disappears while many fixed expenses remain. This is why charter rates matter so much. When global demand rises, daily rates can explode. A ship that normally earns $25,000 per day might temporarily command $50,000 or more. The owner hasn't doubled the ship's size. They haven't doubled the crew. They simply caught a better market. And that's the hidden engine: utilization plus pricing power. Smart owners don't chase maximum revenue every day. They chase profitable days. Because in shipping, one bad contract can erase the profit from dozens of good ones. The ship doesn't need to be busy. It needs to be economically busy. So far, the numbers sound attractive. Now comes the part that destroys owners: leverage. Shipping is brutally cyclical. Freight rates can surge when global trade is strong, then collapse when demand falls, or too many new ships enter the market. Take Hanjin Shipping. Once one of the world's major container carriers, Hanjin filed for bankruptcy in 2016 after years of financial pressure and heavy debt. When freight rates weakened, its enormous fixed costs and debt obligations became impossible to carry. Ships were stranded, cargo was delayed, and the company eventually collapsed. Read that again. The ships didn't suddenly become worthless. The economics around them changed. Another warning is General Maritime, a major tanker operator that filed for bankruptcy in 2011 after a prolonged downturn in tanker markets. The company had substantial debt while daily vessel earnings fell sharply. Its ships still existed. Its operating business still existed. But the cash flow couldn't support the balance sheet. And that's the central failure mechanism in shipping. Owners often buy ships when rates are high, because high rates make the returns look incredible. Banks are more willing to lend. Investors become optimistic. New vessels get ordered. Then the cycle turns. Charter rates fall. Fuel remains expensive. Interest payments continue. Maintenance doesn't disappear. Crews still need salaries. Suddenly, an owner can have a $50 million ship generating $15,000 a day while carrying debt payments based on a market that no longer exists. That's how shipping fortunes disappear. Not because the ship sank, because the spreadsheet did. So, what does the economics of owning a ship actually look like? Let's use a $50 million commercial vessel. In an optimistic market, the ship might generate $12 million in annual revenue. After fuel, crew, insurance, maintenance, administration, and other operating expenses, perhaps $4 million remains before debt service and taxes. If the owner has manageable financing, that could translate into roughly $1.5 million to $2.5 million of annual owner profit. That's a potentially attractive return. But that's the optimistic scenario. In a normal market, revenue could fall toward $8 million. Operating costs might consume £5 million, leaving only £2 million before financing. After interest, principal payments, taxes, and unexpected repairs, the owner's actual profit might shrink to $500,000 or less. And that's assuming the ship stays operational. A major breakdown can destroy months of profit. A market downturn can destroy years. So the realistic economics aren't about making enormous margins every year. They're about surviving the bad years long enough to capture the great ones. Because shipping is a leveraged bet on global trade. You are betting on freight demand, fuel prices, interest rates, port congestions, geopolitical stability, and the future value of your vessel, all at the same time. That's why experienced owners obsessed over cash reserves, debt structures, charter contracts, and timing. The ship itself is just the asset. The real business is managing the cycle, and that's the final rule. In shipping, revenue makes you look rich, cash flow keeps you alive, and leverage decides whether you survive.